Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So the stock market investing community absolutely loves a quote. Warren Buffett is one of the most quotable people alive, surely. Charlie Munger, his business partner, is absolutely the same, and there are many other famous investors that have had great sort of one or two liners that we can learn a lot from. So in this video, I want to go through some of my favorite quotes from my favorite investors, give you some of my thoughts on kind of what they're trying to say and how we practically apply that to investing. So I hope you enjoy. If you want to drop your favorite quotes down the comment section below as well, that would be great. Would love to hear some of your thoughts on that. But with all that said, let's get straight into the video. Okay, so I'm going to start this video out with the OG of value investing, that being Benjamin Graham. And one of my favorite quotes from Ben Graham is, "Intelligent investor is a realist who sells to optimists and buys from pessimists." Now, Ben Graham is the father of value investing. He has written several books, his most famous one certainly being The Intelligent Investor. He's also written Security Analysis, and for a long time he was a teacher at Columbia University, and one of his most famous students ever is Warren Buffett. So he's an absolute legend of the value investing community, and one of the core lessons that Ben Graham tries to teach to all of his students is to buy undervalued securities, buy undervalued stocks, undervalued businesses, undervalued bonds in some cases. And really, you can only capture those opportunities a lot of times when people are very emotional. And as an intelligent value investor, it's important to stay rational and really understand what something is truly worth based off its fundamentals. If you're buying into a business, you're looking out at the future cash flows that you expect that business to earn, and you come up with some sort of intrinsic value number for that company, or an intrinsic value range at the very least. Now, in order for you to make good returns, Ben Graham is saying that you have to be a realist. You have to be realistic, if not slightly conservative, with your valuations as an investor, and you can buy securities from people that are super pessimistic about that company and are willing to sell those shares at below their intrinsic value. And once you've held on to that stock for a period of time and it appreciates up to intrinsic value, then you're in a position to sell to people who are way too optimistic about that particular business. So that's one of my favorite quotes from Benjamin Graham. That piece of advice worked really well 100 years ago, and it will still be working really well 100 years from today. Okay, so the next quote we have is from Warren Buffett's longtime business partner at Berkshire Hathaway, and the guy that always sits up behind me in these videos, and that is Charlie Munger. And this is a Charlie Munger quote that I've been pondering quite a bit as of late. And the quote goes that opportunity comes to the prepared mind. Now, both Warren Buffett and Charlie Munger, especially Charlie Munger, are very well known for having this unique combination of being extremely patient, but also extremely decisive and quick to act when opportunities do come up. And one of the things that I really get out of this quote from Charlie Munger is that although you don't have to act very frequently, you have to be ready and able to identify opportunities when they do come up. If the stock price of an investment goes down a lot very quickly, or if some new business comes on your radar that, maybe you see another investor buying, or there's something happening within that company that means that that is potentially a really attractive opportunity, you have to be in a headspace to be able to analyze that very quickly and very rationally, and then come to a decision quite quickly. One of my favorite stories on this topic from Charlie Munger is actually going back to the global financial crisis. Now, Charlie Munger is an investor that almost never has a transaction. He's owned Costco for decades. He's owned Berkshire Hathaway for decades. He owns some other little bits and pieces kind of around the edges, but he very rarely actually buys or sells anything. A lot of his investing is just kind of sitting on his backside and letting great businesses compound. But every now and again, we do have these very rare opportunities come up, and Charlie Munger acts extremely decisively on them. Now, if we go back to the 2008-2009 financial crisis, there's this quite famous story of Charlie Munger driving down the freeway, and to Charlie Munger's credit, he actually pulled over his car on the side of the freeway. This is a guy that never has a transaction pretty much ever. He pulled over his car because he thought that it was super urgent to buy into some bank stocks. He saw that they were at extremely attractive prices. He's extremely patient, but when opportunities do come up, he does jump on them. So he pulled over, he called his broker, he bought Bank of America and Wells Fargo, and probably a little bit of a fluke, but he basically almost exactly to the day bottom ticked both of those stocks during the financial crisis and bought them at about as cheap a price as they ever got to. And if you fast forward 10 or 11 years now through to today, he still owns those two stocks in the Daily Journal Corporation portfolio, and they've been massive home runs for him over the past decade. Now, the next quote we have here is from Lee Lu, and the quote goes, "Investing is about intellectual honesty. You want to know mostly what you don't know." And this is basically a quote about circle of competence and making sure that you're operating within an area that you understand really well and where you potentially have an edge over the average investor. Now, I think a lot of people, particularly newer investors, fall into the trap of investing in things that they don't necessarily completely understand. And one of the real superpowers of great investors is that they not only know certain things about businesses, but they also have a really good understanding of what they don't know. For Warren Buffett and Charlie Munger, for a long time it was technology stocks. For someone like Mohnish Pabrai, it's pharmaceuticals. For someone like myself, it's possibly banking stocks, for example. And it's all about really trying to operate in a space that you understand really, really well and trying to stay away from things that are getting towards the edge of your circle of competence or that are outside of your circle of competence altogether. So it's really important to know what you don't know, and often that is an impossible task unless you can completely stay away from things that you don't understand extremely well. Now, the next quote I have is from one of my favorite investors, and that is Mohnish Pabrai. And the quote goes something like this: "Heads I win, tails I don't lose much." And this is sort of a mental model that I've been able to get in my own head that has allowed me to invest in things that I wouldn't have really been able to without having that mental model available. And it basically ties into one of the other ideas that Mohnish Pabrai often talks about, which is this concept of low risk and high uncertainty. With a lot of businesses, there is often a wide range of potential outcomes, particularly with many commodity businesses, for example. And when people see uncertainty in the stock market, that typically creates a lot of fear and a situation that a lot of people don't feel comfortable investing in. Now, there are certain exceptions to that, and that is what Mohnish Pabrai is trying to get at here. Now, if you invest in a business that has a very wide range of outcomes, maybe just to put some numbers on it, it could earn anywhere from $1 per share next year all the way to $5 per share next year. No one really knows what's going to happen. Now, a lot of people will view that as very uncertain, and that's correct. It is very uncertain what the business will do within that range. But whether or not it is actually highly risky is an entirely different question. Now, if you can buy that business for, say, $2 per share, and it's going to earn at least $1 per share next year, but it could earn as much as 5 or 10 or 15, that is actually a very low risk proposition in terms of you losing money over a long period of time. So those are the situations that I like to be in. Those are the situations that Mohnish Pabrai likes to be in. Heads I win if that business does earn more than $1 or $5 or $10 or whatever it is per share, and you can buy it for $1 or $2 per share, you're going to win a lot. And if you're wrong on that business and you sort of flip tails and you lose and the business doesn't perform as well as you might have hoped, then you don't lose much. And those are always great situations to be in. We have this sort of asymmetric bet where the upside is fantastic and the downside is very muted. Now, probably one of the most overused quotes in investing, but one that kind of sums up a lot of these previous lessons, and one that does still really resonate with me quite a lot, is from Warren Buffett, the Buff Dog, the man himself, and that is, "Be fearful when others are greedy, and greedy when others are fearful." And this, frankly, is just a modern twist on the Ben Graham quote that we talked about earlier, where the intelligent investor is a realist who buys from pessimists and sells to optimists. We're trying to look for this variation from intrinsic value in terms of what the stock price is doing relative to that underlying value. And when there's a lot of fear in the market, when people are scared about particularly short-term issues, that can create some really low stock prices relative to that intrinsic value. And if we're in a greedy, robust kind of market where everyone is super optimistic, that can create very high prices that we then have the opportunity to sell things at, more than what they're worth. So be greedy when others are fearful and be fearful when others are greedy. Warren Buffett did not get to where he is today by following the crowd and, only buying things because they're going up or selling things because they're going down like a lot of people do. He did pretty much the inverse, and it has made him one of the richest people on the planet. Now, those are some of my favorite quotes from my favorite investors of all time, and I would love to hear some of the quotes that you really relate to as well. So drop them down in the comments below and I'll be sure to check those out. But that's all from me today. I do hope you enjoyed the video. If you did, drop a like. It does help the channel out a lot. And with all that said, I will see you in the next one. Cheers.